You've probably seen a headline like, in 2023, the economy added roughly 3 million jobs. These headlines often follow the Bureau of Labor Statistics Monthly Employment Situation Report, which takes data from establishment and household surveys and provides a real-time look into the evolution of the labor market, including employment and wage growth, the unemployment rate, and the labor force participation rate. Along with payroll and premium growth in workers' compensation, these are all key metrics to assess the health of the economy. But there's more to the story. Let's add some context to those numbers. Overall employment did grow by just over 3 million jobs in 2023, but what actually happened was that over the course of the year, there were more than 71 million new hires, and about 68 million people left their current jobs, either by voluntarily quitting or being discharged. So why is this important? Both the net change in the workforce and the total amount of job turnover tells us even more about the labor market. For example, it tells us that new and growing firms are contributing to labor market dynamism, and that in a tight labor market, workers can voluntarily change jobs to find a better match or wage. At the same time, we're also seeing that workplace stability has value as experienced workers gain valuable firm-specific knowledge and expertise. Here's another example of how context matters when considering job numbers. In January of 2022, the economy added about 250,000 jobs from the previous month. In June of 2023, the economy also added about 250,000 jobs. Same labor market dynamics, right? Not quite. Let's dig into more detail from the Job Openings and Labor Turnover Survey, or JOLTS for short. Fed Chair Jerome Powell has frequently cited the report's number of unemployed workers per job opening as a measure of supply and demand imbalance in the labor market. The JOLTS report also contains important details about hires, voluntary quits, and layoffs and other separations that can help deepen our understanding of how the labor market is evolving and what the impact will be to workers' compensation beyond just payroll and premium growth. Returning to our example, January of 2022's job growth came from roughly 6.5 million people hired in the month, with about 6.25 million people leaving their current job at the same time. In June of 2023, only a little less than 6 million people were hired, with about 5.75 million people leaving their jobs. So what we have here is the same net employment growth, but with 500,000 fewer people in a new job. That's especially important in workers' compensation because employees with fewer than 12 months tenure in their current job have a statistically higher likelihood to file a claim compared to longer tenured workers for many job types. As the number of new monthly hires declines, fewer new workers are being added to jobs each month, even as the workforce continues to grow, and this can reduce workers' compensation frequency. The JOLTS report provides an objective view into what's happening in the labor market. Over the past few years, we've all heard reports of significant layoffs at prominent companies, leading to further speculation around the state of the economy. In reality, total layoffs have been lower than pre-pandemic levels. Over the past 3 years, an average of around 1.5 million workers have been laid off or fired in any given month, with 2023 averaging 1.6 million monthly layoffs and discharges. In the 5 years prior to COVID-19, layoffs and discharges averaged 1.8 million per month. While layoffs can be damaging and disruptive to the affected workers, the rate of layoffs both before and after COVID remain near record lows. Low unemployment and solid hires rates, along with continued elevated job openings rates, point to a continuing strong labor market. So the next time you see something like, in 2023, the economy added roughly 3 million jobs, you'll know there is more nuance to the story that informs what's happening in workers' compensation.